me tell you guys something. I see people on YouTube always pushing Rithm Capital and saying that the 10% yield is the answer, but if you look at the price since 2013, it's still lower than where it started, and it's been 13 years. You get dividends, sure, but your investment keeps losing ground and shrinking in value. There's no real growth, in my opinion, no recovery, just decline. Stay with me because I'm going to show you the full picture. Quick disclaimer before we get into it. This is not financial advice at all. I'm not telling you guys to buy or sell the stock, so please do your own research before you buy or sell anything. And with that, let's keep going. Now, to be fair, Rithm Capital is not some random company that just appeared overnight. This is a real asset management and real estate investment firm that has built a massive platform over the years. They manage billions in assets, they've made major acquisitions, and they generate steady cash flow from mortgage servicing and lending operations. So on paper, this company actually looks pretty solid. But here's the part that confuses me. If the business has been expanding, acquiring companies, and growing its asset base, why has the stock struggled so much for over a decade? That's exactly what we're going to break down. Let's take a closer look at what Rithm Capital actually does and where the money really comes from. At its core, Rithm Capital operates across three main areas of mortgage and credit ecosystems. First, mortgage servicing rights, also known as MSRs. This is one of the most important part of the business. When homeowners make their monthly mortgage payments, companies like Rithm earn servicing fees for managing those loans. That means handling the billing, processing payments, and managing the loan over time. It's a steady revenue stream, but it's also very sensitive to interest rates. Second, the company operates through NewRez, which is a large mortgage origination and servicing platform. This part of the business generates revenue from originating new home loans, refinancing mortgages, and servicing existing borrowers. Third, Rithm invests across real estate, credit, and lending platforms, financing residential properties, real estate projects, and other credit-related investments. All of these operations generate revenue through things like servicing fees, interest income, and gains from loan sales. And this is why the company is able to support such a large dividend payout. The business is designed to generate cash flow from mortgages and credit markets, then distribute a big portion of those profits back to shareholders. But there's an important trade-off with this type of model. Because the performance of these assets is heavily tied through interest rates and housing market conditions, when rates move, the value of mortgage servicing rights can change dramatically. Loan origination slows down, refinancing activity drops, and suddenly the entire ecosystem becomes more volatile. So while the company can generate strong cash flow in good environments, the business model itself is very sensitive to macroeconomic conditions. And that sensitivity is something investors really need to understand before buying a stock like this. So the big question is Rithm Capital actually worth investing in? It really depends on what type of investor you are. If your goal is income, I understand the appeal. The dividend is over 10%, which is extremely high compared to most stocks. And to their credit, the company has been able to maintain a fairly stable dividend over time. For investors focused on generating cash flow, that can look very attractive. But if you're investing for the long-term growth, the picture becomes a lot less convincing. When you zoom out and look at the stock's long-term performance, the price has struggled to build real momentum. Despite the acquisitions, the expansion of the business, and the growth in assets, the market hasn't rewarded the company with a strong price appreciation. Some investors argue that the real return comes from reinvesting the dividends, and that's a valid point. Dividend reinvestment can absolutely improve overall returns, but high dividend yields can sometimes be a warning sign, something investors call a yield trap, where people chase a dividend while the stock itself continues losing value. So for me, it comes down to this. If you want income, Rithm might make sense, but if you're looking for growth, this stock may leave you disappointed. And with that being said, now I want to hear from you. Do you think Rithm is a solid dividend play, or do you think it's a classic yield trap? Drop your thoughts down in the comments because I do read them all. And if you're new to investing and want to start building your portfolio, check out the links in the description. description. If you sign up for Robinhood using my link, you can get a free stock worth anywhere from $5 to $200 just for opening an account. So it's free and it doesn't cost you anything, and you earn money through a free stock. So yeah, you can think of it as free money. You can honestly just sell the stock and cash it out right out of your Robinhood and put it into your bank account. But if you sign up using my Coinbase, you'll get $10 in free Bitcoin after you make your first trade of $5 or more. And with that being said, if you enjoyed this breakdown and want more honest stock analysis without the hype, make sure you like the video, subscribe to the channel, and I'll see you in the next one.